The broadcast is now starting. All attendees are in listen-only mode.
Welcome everyone to Nova 401k Associates webinar, Common 401k Plan Errors with Steve Best. Before we get started, I'd like to point out the panel on the top right-hand corner of your screen. You will see a drop-down section for questions and chat. This is where you will enter in any questions that you may have for Steve. He will be answering questions throughout the session. And if time runs out and you still have questions, please send them to our email address, webinars@nova401k.com. Right below questions and chat, you will see the handouts drop down. Here you will be able to download today's material. If you are with us today to earn continued education credits, please be sure to stay until the end of the session to fill out our pop-out survey. This will allow us to track your time and participation. Certificates will be sent out within a week for those who have met the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or you can visit our website, which is www.nova401k.com/webinars. Thank you for joining us today. I would now like to introduce Nova's Vice President and Shareholder, Steve Best.
Good afternoon, everyone, and thank you for being on the webcast today. We're going to be dealing with some of the more common problems that not only we see in our practice, but also some of these errors are also listed in the IRS's list of more common errors that they also find when they audit plans. I'm going to skip this section since essentially it was covered already, but you know, for the CPA credit and everything. Anyway, we've got a fairly long presentation, so we'll get right to it. Again, really what we want to get across to you today is, number one, be able to identify, you know, who is a fiduciary in the plan and who's not. And then we'll go through some of the more common administrative errors that we see and how to avoid them, and also how to correct them, because most of the errors, even if they do occur, have a specific correction that the IRS has outlined in their correction programs. Quick overview of the service model that you are all operating under with us, in case you didn't know, but we work as a team with other providers to service your 401k plans. So typically in any 401k arrangement, there are four distinct roles to be played. The one that's not on here is the one that your company plays, but the other players here include the investment provider. So we partner with, you know, quite a few different firms, whether it's John Hancock or Voya, you know, American Funds. We've got a lot of different investment company partners, and they provide the mutual fund platform. They, you know, provide the tax reporting when people take distributions, a lot of the investment education and communication. You know, again, the 1-800 number, that's where you're sending the money, you know, when you take it out of people's checks. Now, NOVA is the TPA, which stands for the third-party administration firm, and we handle all of the government compliance, kind of like a CPA would for an individual. So these plans are heavily regulated by both the IRS and the Department of Labor, and we keep you in compliance with those regulations, which include the annual testing we have to do on your plan every year. We keep your plan document up to date with current legislation. Depending on the investment provider you work with, where we may be involved with the distribution and loan approval, not approval, but review. And then we also prepare the annual government filing that your plan has to file with the Department of Labor every year. And then finally, neither the investment provider or our firm is licensed to give specific investment advice. So that's where your investment advisor comes into play. You know, he'll do an annual review typically with your firm to review the investment lineup, you know, answer questions that your employees may have about which funds might make sense for them to invest in. And so everybody brings their own different expertise where we feel this model is providing the best overall service for you. So in terms of this webinar today, it is important because we find that operational failures, which are failures to follow the legal terms of your plan document in actual operation, are a lot more common than investment-related losses, which you tend to hear a lot about on the internet and maybe on the news. But in reality, we see plans paying up more penalties and fees to correct errors due to operational problems, not investment-related problems. And you know, fiduciaries to the plan do bear personal responsibility for these breaches. Now, not every error that we'll discuss today is a fiduciary breach, you know, that the fiduciary would be personally liable for, but the company at the very least, you know, is usually on the hook to pay the cost to fix whatever the issue is. So the Department of Labor and the IRS both do monitor 401k plans in different ways. And this chart just kind of shows you some of the more recent restorations, fines, and penalties that they recoup based on plan audits and correction programs and so forth. Also, they've increased the penalties that they're assessing dramatically a couple of years ago. And you can see the difference here. It's just gone up by a factor of like 100, right? So, you know, filing 5500s late, for example, or, you know, various notices and SSA forms and so forth. So the penalties can be pretty steep and significant if you don't comply with the regulations. Now, the IRS does have a program for fixing problems that do occur, and there's three parts to it. There's the self-correction program where you don't actually have to have a formal filing with the IRS to fix a problem. You just fix it yourself using the principles and guidelines that are in their written program, which is a revenue procedure that outlines how you fix various things. And then there are other errors where you actually do have to do a formal filing. This is the voluntary correction program, you know, and you pay an upfront fee to use that program, and our firm would prepare a formal filing where we go in and ask for a specific correction to be approved by the IRS. Okay, and then finally, if they happen to just catch you in open audit, right, like you had a problem, it was never fixed, and you just happen to be unlucky and get audited by the IRS, or your plan gets audited, they would fix any audits under audit cap. And again, the difference here is just that the penalties for fixing the problem go way up when you're under audit cap. The initial fee for a VCP filing, as you can see here, is based on your plan assets at the end of a particular plan year that you're trying to fix. So, you know, for smaller plans up to 500,000, 1,500, then 3,000 for the intermediate plans, and then the large plans are 3,500. And this is just the fee that's paid to the IRS. This has nothing to do with contributions you may owe to the plan or fees that you may have to pay NOVA to help do the calculations to fix the problem. This is just the IRS fee. So under ERISA, there are three types of fiduciaries that they cover and describe. We're not going to talk about the first two. Those are all investment-related fiduciaries. But the more important one that we want to talk about today is the 316 fiduciary, which is defined as the plan administrator. Okay, so a fiduciary in general is any individual or entity that exercises any discretionary control over the plan administration, or exercises control over the plan assets, that's where your investment people come into play, or renders investment advice to the plan for a fee, which would be your investment advisors, your brokers that are the partners on your plan, right? So some examples are, again, your investment advisors, the trustees that are named in the legal plan document that NOVA prepares for you, investment managers at the investment companies, you know, Hancock, Voya, you know, Principal, whoever you're with, If you have an administrative committee that makes decisions about the plan, then everybody on that committee is a fiduciary as well. The plan administrators themselves, the individuals in your companies that are approving the loans and distributions and signing the 5500s, and administering the plan, obviously with our assistance, but, people within your firm are fiduciaries. And then again, anybody that hires or fires any of the people above, which are generally going to be the owners of the company, whether they're trustees or not. So the 316 fiduciary, again, is defined as an individual who's a plan administrator. These individuals are not named in the plan document, and they're not required to be named in the plan document. So generally, we don't see that, and whenever that's the case, as it is in most plans, then it's the plan sponsor, the person in your company that's dealing with the plan administration, right, and the company itself is the 316 fiduciary to the plan. All right. Just to give you some idea of some of the duties of a 316 administrator, there are a variety of annual notices that have to be distributed. Like I'm sure a lot of your plans, the people on this call right now have safe harbor plans. There's a safe harbor notice that's annually required to go out. Whenever we update your plan documents, there's a summary plan description, the SPD, that describes the provisions in the plan that has to be distributed to participants. Neither our firm nor the investment provider passes those out. NOVA prepares that SPD, but we give it to you to distribute to your participants. That's your responsibility. So there's a variety of responsibilities that people at your company are responsible for. And this is just a short list. This is not everything. Again, we can stop at any time once I start going through these slides. If you have questions, just type them into the box, and Yvette will stop me and we can talk about a particular slide, or maybe even go back to one if it's past, but feel free to ask questions as we go along. So getting into some of the more common mistakes, number one would be the failure to amend your plan document for current law changes. So Congress changes the regulations on and the laws on governing 401k plans all the time. In fact, some of you may have heard of Secure 2.0 being the most recent legislation from Congress to affect 401k plans. And basically every 6 years or so, plans are required to update to new plan documents. So almost all the providers that like TPAs, like NOVA, we use template documents that have been pre-approved by the IRS, and they come with a certification letter from the IRS saying that so long as you don't go outside the blanks of this adoption agreement, you have a qualified plan. And so they update these template documents every so often, usually about every 6 years, and then they require your companies to update to these documents, right? We just went through a recent update called the Tri-Cycle Restatement, and all of you, got notified that you needed to sign a new document. And if a document restatement like that is missed, right, by a certain deadline, then you generally have to go in under the IRS's voluntary compliance program, which again, as we see, costs money. So it's fixable, but it does cost some money if you miss a required restatement or required amendment. So just keep an eye out for, NOVA prepares all of these amendments and all of the documents by the deadlines, and we send them out to you for signature. The way you avoid this problem that we were on the previous slide is to make sure you're paying attention to your emails from us and executing the documents in a timely fashion. And we do a lot of follow-up with you to make sure that you don't miss your deadlines. but always be on the lookout for instructions regarding amendments and required restatements. Another common problem is the failure to sign up all of your affiliated employers. So many companies, have other employers that have co-ownership. All right. So one thing to keep in mind is only the companies that have executed a participation agreement for your 401k plan, the legal plan document, are permitted to participate in your plan. So if for some reason you have a parent company and 3 subsidiary companies, right, all employing people, if you haven't signed up the 3 subsidiaries and it's only the parent company that's signed up for the plan, the other 3 are not permitted to participate. Okay, and then there's special testing we have to do to make sure that that's even permitted, right? I mean, normally you want all of the employers to be participating in one plan. So there's something, what is this affiliation, right? It's, the most common type is called a controlled group, all right? And generally, if you have a controlled group of companies, you want all of them participating in the same plan, all right? Now, what is a control group? There's 2 varieties. If you have one company that owns at least 80% or more of another company, then the IRS views the 2 companies as just one for plan purposes, right? And you're really not permitted to exclude more than about 30% of your total employees from a plan. So it would be problematic, obviously, if you have one company participating in the plan and you haven't included the other one and you're part of a control group. Right. The other type of control group is owned by individuals. So if you have the same 5 or fewer individual owners commonly owning 80% or more of 2 companies, then again, you've got a control group. So again, I just talked about this, how do we avoid the amendment issue? Just make sure you're reading all the correspondence, and we'll do a lot of follow-up. But also, in terms of the participation agreements, that is something that we would amend your plan for. If for some reason you're aware of either a sale of your company or you're purchasing another employer, you need to call us as soon as possible so that we can consult with you about what effect that might have on the plan, right? Because you may be a single company and all of a sudden you go buy another company and now you're in a control group. You need to know how to handle that for plan purposes. So always contact us ahead of the acquisition, preferably, so that we can provide you with some consulting on what to do. So failing to follow the provisions of the plan document is very common. We see a lot of errors here, especially with new plans that we take over, right? But the IRS requires that you follow the terms of your written legal document in practice, and if you don't, they reserve the right to disqualify your plan, right? Which is something you really don't want to happen. Again, the IRS does not disqualify plans easily, right? So long as we make an effort to fix whatever the problems are, there won't be an issue. It may cost money, but you won't get disqualified, which would be the most expensive possible penalty. So under not following the terms of your plan document, the most common problem is following your plan's definition of compensation. Excuse me. So compensation, that you use to apply the employee elections and any employer contributions that you might be making is defined in the plan document. And in payroll, if somebody says take 10% out of my pay and you're taking 10% out of the wrong definition in payroll, right, or not the definition that your plan document says, you've got a problem because people are going to be getting the wrong allocations, right? You will make the wrong deductions, and if you're computing a match, the wrong matching contribution will be calculated. So most plans define compensation as total gross W-2 pay. So you can exclude certain items, bonuses, commissions, any variety of things, but that has to be written into your plan document. You don't get to just do it in payroll. So if you're thinking about excluding something or possibly changing something in your plan document, we have to, just talk to your Nova account manager, and we may need to do an amendment to your plan document. So here's just a, excuse me here, a simple example. If you have a company that adopts a matching formula and, they have to program the payroll system to calculate the match, and they use base pay, but the plan document indicates that it's total gross, then all your computations are incorrect. So we would normally fix that under either the self-correction program, or depending on how far back it goes and how significant the problem is, the voluntary compliance program. So how do we avoid this? Again, you need to know what your plan document says, and what the definition of compensation is. They are a little harder to read. So if you have a problem, again, just call us and we can help you out. Also, make sure that, whoever's handling your payroll has to understand that, what are the plan provisions. These are the most important people to understand what those provisions are, to make sure that things are coded correctly in the payroll system. So not following the initial waiting periods of your plan properly. So not letting your employees, or not offering the plan to your employees in a timely manner. Again, very common problem. The thing to keep in mind is, all that matters is what the document, the legal plan document says. Doesn't matter what you wrote into an HR policy or somebody's offer letter. That has no bearing at all on this. And so you need to comply with what the document says. And sometimes people let people in too early or too late. We see both problems. All right. So again, for example, if your plan has no age or service requirement, it's immediate entry, and you hold out Steve, for 6 months, or you don't offer the plan for 6 months, we have a problem. And the way we fix that problem is that the company is going to have to make Steve whole for the missed contribution. Normally we use an average rate for what the other people are contributing, so that, let's say it's going to be 3%. The employer, your company, would have to make up some of that missed deferral, because he should have been contributing right off the bat, for the 6-month period that you missed him. We're going to have to do a calculation, and you'll owe a contribution plus the earnings on that contribution and have to fund it to Steve. The employee doesn't fund anything. Now, obviously, you let them in, but for that period that they missed, the employer funds all of it, plus any match or employer contribution that was due. So just a little background on initial eligibility, because I do find that employers don't understand how the waiting periods work and how to calculate them, because again, we do not tell you when to offer the plan to your employees. That is one of your responsibilities to, because companies hire employees throughout the year, and we don't know who you're hiring throughout the year. We just ask for annual census to do what we have to do, right? So the maximum waiting period in a 401k plan of any kind is 1 year of service and age 21 with a minimum of 2 entry dates. All right, I'll show you how this actually works on the next slide. Now, a certain number of hours may be required to accrue the 1 year of service. Typically, this is 1,000 hours. It can't be more than 1,000, but that's the standard usually, is 1 year of service and 1,000 hours worked within that year. And then the maximum age is age 21. Not permitted to have an age 23 requirement, for example. People can be younger, that's fine, but not older. this is the part that most employers do not understand how this works. The initial computation period to determine the 1-year wait is the 12-month anniversary date from the original date of hire. Okay, and then typically changes to the calendar year if they don't qualify in the initial computation period. So that sounds very complicated, but this is what it looks like. If you hire somebody, for example, in June of 2022, you go to the 12-month anniversary date, which would be June 1st of 2023, and you ask the question, did they work 1,000 hours in that period? And you can see it crosses calendar years, right? So the initial computation period is required to be the 12-month anniversary date from the original date of hire, not a rehire date or something like that, okay? And if the answer is yes, then they accrue 1 year of service on 6/1 of 2023, on the anniversary date. Now, most plans have an entry date as well, right? Like in this case, it's semi-annual, which means the first day of the plan year, and July 1st is the second entry date. So this person got the 1 year service on 6/1/2023. You should offer them the plan in enough time to where they can make an election for pay periods after 7/1 of 2023. So sometime in June would be appropriate in this case to give them their enrollment materials or a link on how they can enroll online with your investment provider. And then you have to get their elections into payroll after, for pay periods beginning on or after 7/1. Now, let's say in the initial computation period, they did not work 1,000 hours. They worked 500 hours. This switch in the computation period that I was talking about is, okay, they didn't get the 1,000 hours in the first computation period. Now, to make it a little easier on you for subsequent periods, the documents switch the computation to the calendar year. So this person, let's say, didn't get the 1,000 hours. Now you're looking at the calendar year of 2023, and then you ask the same question. Did they get 1,000 hours in that period? And then for every year after that, you ask the same question. If the person's consistently working 500 hours, they never get into your plan under a 1 year wait. So that's how the 1 year maximum wait works. Shorter waiting periods are okay. You can have immediate entry, like first pay period after hire, for example, 3 months, 6 months. The thing to keep in mind with the shorter waiting periods, you can't apply hours to those, okay? So the way elapsed time, it's called elapsed time, but the way that works is from the original date of hire, if you've got a 3-month wait, you ask the question, is the person employed on the 3-month anniversary date, yes or no? If the answer is yes, they get all 3 months. They could have worked 1 hour in the first month and 1 hour right before their anniversary date, and they're in. This does not keep part-timers and other people like that out of your plan. So 6 months is the same way. Are they there on the 6-month anniversary date? Yes or no? If it's yes, they're in. You don't have to ask any more questions than that. So another common problem, excluding classifications of employees from your plan. So, you've got hourly employees, for example, and you're excluding them. Well, that might be okay, but it's got to be written into your plan document. Also, there's a lot of additional testing that NOVA has to do in order to make sure that's permissible. All right, because again, like I mentioned before, you can exclude about 30% of your non-highly compensated employees and be okay, but if it's more than that, the IRS doesn't allow you to do it, okay? So there's extra testing that we have to do. But the key concept for you is know if you've got an excluded class in your legal plan document or not, and you need to follow that in practice. You can't be, I know for health and welfare benefits, part-timers are excluded. It's not the same rule in a 401k plan. So your HR department can't be treating it that way, right? Does the plan document say that they're excluded or not? And then similarly, part-time, seasonal. The IRS does not like any kind of any kind of exclusion language that is based on service. Okay, like part-time, seasonal, temporary, right? They don't like that in the plan documents. They view it as a possible circumvention of the maximum 1-year waiting rule. Okay, now how could that happen? Well, part-timers can work more than 1,000 hours, right, in a particular year, which would normally make them eligible, and you've excluded them. They don't like that. In fact, there's some new regulations coming up here that are going to affect who you have to include in your plan. They're called the long-term part-time employees. Okay, if you've got part-time employees who are the same people are consistently working for you on a part-time basis for a long period of time, very shortly you will not be able to exclude them at all, even if your plan document says you can. Okay, so be thinking about, I don't know all the plans that are on the line right now, but start thinking about that. This is a whole separate webinar. There's a lot of information on these new rules. If you want to see some videos that we pre-recorded, go to our YouTube channel, which is listed here, and you can watch that webinar. We just had an update to that webinar on Tuesday of this week, and we're going to post a video, I think, tomorrow. The updated video. There's one out there from a year ago, which is still pretty accurate, but we're still waiting for guidance from the IRS on these. But just be aware, they don't like part-timers being excluded. The IRS doesn't. So again, you need to be aware of what are the eligibility waiting periods and the entry dates in your plan document, and you need to be applying them in practice properly. All right, which includes not excluding any classes of employees unless your document specifically allows for it. Now, good practice always is also to, when you're offering the plan to people, keep some sort of record that you offered the plan and when you did. Because if you happen to be unlucky enough to be audited by the IRS, they want to see that. Show me proof that you offered the plan in a timely manner to your employees. If, like, for our plan, our NOVA plan, we have a group of employees where email is okay to, use as a method of enrolling them. And I always save a copy of the email where I sent it to 20 people and said, hey, you're all eligible, here's the paperwork. And I save that on our computer for our record, so that no one can question whether I offered the plan to my employees on time. You should do the same. Now, how do we deal with rehires, right? Because this can be confusing to a lot of plan sponsors as well. The easy rule to remember is if you had a formerly eligible employee, who ever had a single vested dollar in the plan in the past, they never lose their prior service credits. Okay? That's if they never had any money in the plan at all of any kind, then you get to they lose their prior service credits after 5 consecutive 1-year breaks. Okay? Now, most companies don't usually rehire people after 5 years, so it does happen, but it's pretty uncommon. So in general, if you had a previously eligible employee who had any kind of money in the plan, the minute you hire them again, offer them the plan immediately. They don't have to requalify under whatever your waiting period is. They don't have to wait for the next entry date, none of it. The minute you rehire them, you should offer them the plan. So we've been talking about how you get credit for a year of service, for eligibility, for example. It's a little bit different rule for vesting. Now, again, you don't track vesting. We track that in our system. This is more for your information to show that it is a little bit different. So by law, again, service for initial eligibility has to be credited from the original date of hire. Okay? But service for vesting, like if you got a 1-year service requirement, It's computed on a plan year basis. Okay. Hold on, I didn't silence all of my stuff here. Okay, so let's see here. I'm sorry. I was getting pinged for another meeting, and I didn't shut that down. So back to service crediting. A year of service you can also have a year of service requirement for accrual to receive an employer contribution. So some companies are making a match, profit sharing, what have you. So even though an employee is eligible to contribute, you can attach additional requirements to receive the employer contributions. For example, you can require them to be employed on the last day of your plan year in order to get the match or the profit sharing, but don't confuse it with initial eligibility. They're eligible to contribute themselves. They just might not be eligible to receive the match when it's calculated. This is not an issue if you're doing a payroll by payroll match or payroll by payroll contribution of any kind, but some plans have annual calculation periods, which NOVA does the calculation, and we can exclude some employees based on how your document's written. So, all right. Loans also a very common provision in plans, and problems do occur with them. Again, a loan is not a taxable distribution, but you have to meet certain requirements. So, loans that exceed the maximum dollar amount, are going to have a problem. They have to have certain repayment schedules, and probably the most common issue that requires loan corrections are loan repayments not being started on time in payroll when somebody actually takes a loan from the investment provider. Okay? So if a loan becomes delinquent, meaning there are missed payments, right, then there's a certain amount of time you have to fix that problem. So a delinquent loan has to be corrected by the end of the quarter following the quarter in which the first payment is missed. So if my loan goes delinquent in the first quarter of this year, I have until the end of the second quarter to bring the loan up to speed, right, to cure it, right? We'll talk about how we do that. If it doesn't happen by that time period, then the loan is considered a taxable distribution at that point. So a loan, they're just borrowing their own money, right? But it's not actually a distribution. They pay it back to themselves. But if you go delinquent on your loan, then it does become a taxable distribution at some point, right? So how do we fix a delinquent loan? You can either catch up the missed loan repayments, right? If they've missed a month's worth of loan repayments, then you could set it up in your payroll system to just deduct, 4 payments extra and send those into your investment provider to bring it up to speed, right? Or bring it current. You can also completely pay off the loan. That's always an option for an employee. Again, they would have to send in a check. If they owed $5,000 still, they could do that. Or it could be refinanced or reamortized. So the whole idea here is that the loan needs to be paid off by the maturity date, okay? And if you miss some payments, right, you can't just pick up the same payment amount and start paying it. The payment would have to go up if you miss some. That's the reamortization option. Now, the IRS luckily it used to be that you had to do a formal VCP filing to fix a loan problem after the cure period, right? But now, there are still a few rules, but you can essentially self-correct these problem loans without having to do a formal filing, which is nice, because those formal filings, a plan would never pay $3,000 to do a filing for one loan problem. You know what I mean? So it's nice that you can fix them by self-correction. Exceeding the maximum dollar amount example. Again, the maximum dollar amount that any loan can be is $50,000. You could have $1 million 401k balance and you want to take a loan, max is 50. If you happen to take 60, right, then that excess over the 50 is going to be considered taxable income. All right. So again, all of our investment providers usually are monitoring loans in some sense. Many have reports and or message centers where they'll identify delinquent loans. So make sure you're monitoring your message centers to make sure that you know, you're not missing anything. Also, review the loans that are at your investment provider, because they definitely have reports on who has a loan, right? And you should probably match that up with who you're deducting loan repayments for in payroll. That'll tell you pretty quickly if you're missing anybody, right? Now, obviously, if individuals have terminated and had a loan, they're not going to be in your payroll system. That's okay, right? A terminated individual where you stop the loan payments, the loan does need to be defaulted, right? And normally would be automatically the minute they take the rest of their money. But it's for your actively employed people, you know, that have loans. You should be making payroll deductions, and if there's a mismatch there, that'll tell you pretty quickly if you've got some delinquent loans. Now, big problem area that the Department of Labor is interested in is the timely deposit of employee contributions and loan repayments. Okay, so the DOL does not want employers hanging on to employee money for longer than a certain period of time. For small plans, they've created a separate rule than large plans. So small plans are generally plans that have less than 100 eligible employees. For those types of plans, you have 7 business days after the amounts are withheld to make the deposit. All right. It doesn't apply to the employer money. It's just the employee money, right? So if you're making a match, you've got a little bit more time. Generally, I would not, you know, if you're doing a payroll by payroll match, you might as well send the match in when you send in the employee money, but just make sure it's within 7 business days. Technically, if you had even one payroll that was late, like it was 8 business days, the Department of Labor, if they came in, could say, hey, the 7 business day standard doesn't apply to you anymore. You now have to do what the large plans do. So for a large plan, it's as soon as administratively feasible, okay? And not later than the 15th day of the following month. That second bullet point, even though that's in the regulations, you can forget about that one. They want the money in as soon as administratively possible. So what does that mean? You know, generally what we've seen is the DOL might give you 3 to 5 business days, but they're going to look at how, you know, if you got audited, the DOL would come in and look at how are you processing a lot of your other payments. Like if you're sending in the withholding on a particular pay period in 2 days, and you're holding on to the employee money for 6 days, you know, they'll probably consider that late. If you can get the withholding into the government on time, why can't you get the employee money into the plan at the same time, right? Would be their rationale, right? Also, as a large plan, you're subject to a CPA audit, and the auditors, the CPAs, are looking for this as well because they know that the Department of Labor is looking for it, and it's a reportable you know, transaction on your 5500 form. So again, just an example. You have a plan to fail to deposit employee contributions for, you know, a particular pay period for 3 months, which is clearly late, right? How do we fix this problem? You have to restore lost earnings for the late period, right, which involve NOVA basically doing the calculation for you, and then it's also considered a prohibited transaction subject to some excise tax. I can tell you that the amount of lost earnings are usually pretty minimal, but the computation is complicated. Normally, NOVA has to charge way more to do the calculation and prepare the 5330 form for you to pay the excise tax than the actual lost earnings that you're going to have to return to the participants in the plan. So you definitely, I mean, that's the primary reason to avoid this problem. It's expensive to fix, or more expensive than what you're going to have to make up to the employees anyway. All right, so how do we avoid this? Make sure you understand your applicable deadline. Are you a large plan or a small plan? You know, and make sure you're setting up procedures to ensure deposits are made on time, right? I mean, if you've only got one payroll person, do you have a procedure like when they're out sick or on vacation, is there a backup, you know? If you're running multiple payrolls, make sure they're all getting in at the same time. Like maybe you have multiple companies with multiple payrolls, right? And the key is to be consistent. If I'm going to say I'm getting my contributions in 2 days, then make sure they're always getting in 2 days. You don't want to be bouncing around like 2 days and 5 days and 3 days and you're all over the map. The DOL could come in and say, well, you got like 3 or 4 of these in 2 days. We're going to make your standard 2 days and everything else is late. So you don't really want that. Contributing money to the wrong money source in your plan. So at your investment company, there are different buckets of money for the employee contributions. If there's Roth, which is an after-tax employee contribution, there's a separate bucket for that, the match, the profit sharing. They have to be accounted for separately on separate line items at your investment provider because the distribution rules are usually different for each of these types of money. There's vesting on the match and profit sharing, for example, but employee deferrals are always 100% vested. So there are different rules governing these types of accounts, you know, within an employee's account. And you don't want the money going into the wrong source. So let me see if I can shut down this little pinging noise. So for example, you know, this happens quite a bit actually. You know, a plan will be amended to a safe harbor matching formula from a discretionary match, right? And then, you know, so imagine a company where they were a discretionary match that's going into the match source that's subject to the vesting schedule. Then they make a plan design change here at NOVA and go to safe harbor match. Safe harbor match is always 100% vested, you know, and there's a separate line item for, you know, separate bucket that you need to put that safe harbor match into. And everybody's just on automatic pilot about this design change, and you make the deposit into the same source you were doing originally, right? You don't make the adjustment in the following plan year to get it into the correct source. Well, that's a problem because as people get paid out, they are going to be paid out incorrectly, right? Because one is subject to vesting, and now you've commingled money in the wrong source. So that's something that we do fix here at NOVA, but it can be fairly complicated to fix, and again, expensive. I mean, we're having to charge fees to do that. That's not routine work for us, right? The limit on 401k deferrals, you know, the employee contributions has gone up this year, if you're not aware, to $22,500 for somebody that's under the age of 50, and then somebody that's 50 or older during this year can put an additional $7,500 in. So think about it as two different limits: $22,500 for under 50 and $30,000 for 50 or older this year. Okay, it applies to the sum of, you know, your Roth and your pre-tax, right? It's not two different limits, so you can split your money up between Roth and pre-tax contributions as an individual, but the total limit is the same. Okay. A lot of companies get into trouble here, right? There's also a limit on the match if you're making one because of the annual compensation cap. So there's a separate limit on the total amount of pay that we can count, we being the, you know, NOVA and your plan itself. You know, you can only count $330,000 in total gross comp for 2023. Okay, so somebody can be making $1 million. If your matching formula is 4%, You don't take 4% of $1 million. You take 4% of 330,000. Okay, that's the limit. So that kind of creates a dollar limit that you should probably get into your payroll system. All right. So for example, here we got a discretionary match of 50% on the first 6, and you know, with that we arrive at $9,900 for this year with that particular formula, and we get that number by taking 330 times 6 times 0.5. Right. A lot of you are safe harbor matching plans. Right. Those formulas are 100% of the first 3, and then 50% of the next 2% that an individual puts in. So that formula caps out at 4%. So the maximum any one person this year should get with a safe harbor formula like that is $13,200. Okay. So, you know, you should set up that limit in your payroll system so that your payroll system cuts off the minute somebody hits that number. Right? That's the maximum for sure. Again, just make sure all your dollar caps, both on the employee money and the employer money, are set up in your payroll system. We can fix this problem after the fact, but you know, it's more complicated to do it that way. And if somebody happened to, let's say, you gave somebody too much match, like a highly compensated person making $500,000, and they terminate and they take their money before we can catch it, you know, in the year following your testing year. They've got the money, it's gone, right? So it's better to catch it in your systems with the proper caps. I'll breeze through some of these things. You know, again, there are various notices that you're required to distribute: the summary plan description, fee disclosures, safe harbor notices. If you're an automatic enrollment plan, you know, that's involved as well. I won't spend too much time on these, but sometimes your investment provider is helping, like fee disclosures typically are sent out by them. But safe harbor notices and summary plan descriptions, you have to send those out. We give you, you know, the instructions whenever there's a new SPD or a safe harbor notice, which is an annual notice. We give those to you and say, hey, send this out by this deadline, right? But you have to do it. We don't do that for you, and neither do your investment providers. Okay? Just so you know, summary plan descriptions for every new person, right? You're giving them enrollment materials from your investment provider, right, on how to enroll there. You need to include the summary plan description with those enrollment materials. Those are never, the summary plan description is never included with all the other enrollment materials, like never. So, and the only one that can send that out is you, because you're the ones that are enrolling your participants in a timely manner, right? Here, we're running out of time here. I don't see a whole lot of questions. Let me breeze through this one here. So again, all of this 316 administrative duty and work that you have to do, you know, what can you do? I mean, you actually could hire an outsourced administrator that can take on most of this liability for you. You know, we recognize this at NOVA and created a separate company because, again, NOVA's not actually a fiduciary, okay? But this, you know, the 316 administrator is. Hold on a second. And obviously, it's going to save you a lot of internal time and money because if you think about it, you know, you're not experts in 401k plans. I've had to run payroll you know, myself, and I'm not a payroll expert, so I know just enough to be dangerous. Okay. Anyway, again, it's like a lot of people think that the investment provider in NOVA will handle all the administration, right? Aren't we the 316 administrator? And the answer is no. You know, so we don't actually sign anything here. Like, we'll prepare the 5500. We will prepare the non-discrimination testing. We may even prepare refund forms if your non-discrimination testing fails, right? But we don't actually sign it. We just prepare it and send it to you. By you signing it, you're the fiduciary. We're not. We're just performing a ministerial function to help you out. Okay? The person that signs it makes the big difference. So anyway, this other company, if you're interested in help and you don't want to do most of this yourself, Administrative Fiduciary Services was created to help you out. We have various levels. You have the slides. I'm not going to go through each of these service levels, but they sort of build on themselves. You know, we can send, that company can send out the notices. They can pretty much do almost everything. They'll sign the 5500. If you have refund forms, they'll sign those too. And they'll be fiduciaries for those types of services. Well, that helps you out in that for those particular services, you no longer have the fiduciary liability. If a refund form doesn't go out on time and there's a penalty or a penalty on anything that company takes over, they pay the penalty. You don't pay the penalty, which is nice, you know. It does cost extra money, so if you're interested in any of those services, you know, please contact Araceli, who's on this slide, and her contact information. I don't know if we have questions. Again, please notice this. We've got pre-recorded training videos if you want to watch a pre-recording on our YouTube channel. Or, you know, you can also register for our live webinars like this one at any time by going to our website. It's posted right here. So you can do it either way. If you know, the nice thing about the recordings or the videos is that you can watch them on your own time. This one will be up shortly as well. Yvette, any questions at all at this point?
We did not get any questions. So I don't know if you want to go over another slide if you want to into more detail, or we can go ahead and close out the session. It's up to you.
I think, well, with 3 minutes, I think we're fine. I will say this, the IRS and the Department of Labor, we have that. So I manage a team that all my team does is fix problems. You know, and most of the time the problems are not for our ongoing clients because, you know, NOVA does a good job keeping you in compliance in general. But a lot of the incoming plans, because we actually pick up about 1,000 new plans every year. And we find a lot of mistakes in those plans. And the IRS and the DOL, they're actually, we've started to see some new initiatives from them in terms of sending notices out, checking up on plans that we've never seen before, right? And again, they're kind of fishing for problems. So again, just keep in mind you know, you have to follow your plan document in operation. That's the key idea. And if you don't know what's in your plan document, you need to. You know, certainly the primary provisions you need to know about is the eligibility, right? So that you can offer the plan in a timely manner to your employees. That's probably the key one right there, because no one else does that except for you, right? And then a lot of the notices you're responsible for, primarily the summary plan description. If I had to go audit most plans, I would probably say that very few summary plan descriptions are sent out to newly eligible employees, because plan sponsors think that John Hancock or Voya or Empower, whoever you're with, must be sending that out, right? But they don't. I mean, those summary plan descriptions, number one, are like 15 pages of information that you know, distills all the provisions of the legal plan document into plain English for your participants, and they're simply usually too large to include in the enrollment materials. And the other problem is there's, you know, Empower may have like 50,000 plans, and every one of them has a different summary plan description. They just don't do it. So something to keep in mind. Anyway, thank you for your time today. I hope this has been informational for you. If you have any questions, again, there's my email. Send me an email if you have any follow-up questions. And certainly go look at our YouTube channel. There's a lot of good information for you there that you can just watch on your own time.
Awesome. Thank you, Steve. Just a reminder to go ahead and fill out the survey. Once this webinar concludes, you'll have a pop-up survey. This will allow us to track your time and participation for anybody that is needing a certificate. If you have any questions, you can go ahead and reach out to Steve, or you can email us webinars@nova401k.com, and we can go ahead and forward that over to him. To view any webinars you may have missed and the recording of this session, like Steve mentioned, you can follow us on our YouTube channel, which is Nova 401k Associates, or you can visit our website, which is www.nova401k.com/webinars. Thank you, Steve, for your time today. And thank you again to everyone for joining. We hope you enjoy the rest of your day. Bye.